If you're a couple and you're both earning and got a household income of a couple of $100,000, for every 0.25 is about 25,000 extra you can borrow. We've had 0.5, that's 50 grand. If we end up with 1%, that's an extra $100,000. So that makes the difference. My advice to my clients is get in as soon as you can. I can't see this demand for housing and the upward pressure on prices easing in the foreseeable future. If you wait, you're going to miss out as prices move away from you. One of the great attractions of Perth is the lifestyle. It's the climate, it's the beach, it's the weekend, the holidays, being able to go to Bali or go on your camping trips. A lot of people driving around in very expensive four drives and caravan boats and all sorts of these sort of things. We value that. I think we value our lifestyle.
When I'm doing strategic plans for people, there's usually a bottleneck for someone, and that can either be their income, which translates through to their borrowing capacity, or it's their available equity or deposit.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
So, lots of changes in the finance landscape at the moment. What does it all mean for property investors and home buyers and borrowers? Today, I've got Nick Aves from Purely Finance here to break it down and deep dive on exactly what is going on and what it means for us. So thanks for joining us, Nick.
Oh, welcome, Jared. Thanks so much again for inviting us. Looking forward to our chat.
Well, every time we have a chat off air, I think, I need to be pressing the record button because some of this would be really good for our listeners to tune into. And it's purely out of curiosity for myself. And so I can also help our clients and buyers that we're speaking to every day. So yeah, looking forward to getting into it.
Fantastic. Let's go.
So yesterday we had a interest rate reduction of 0.25. It's our second one for the year. I think most economists were expecting a 0.5% reduction yesterday, or perhaps we were just hopeful. What does that all sort of mean for borrowers, and what does it do for the typical borrowing capacity for people?
Yeah, so I think, initially there was speculation that it would be 0.5. There were some employment figures that came out that were fairly strong, showing low unemployment, and I think that sort of tipped it back maybe to a 0.25. The average across the main banks economists are still predicting 1% for the year, so hopefully that means we've got some more rate reductions to come. Rate reductions, I think, do a couple of things, and I'll go into the numbers in a second, but I think the number one thing they do is they give people hope and a bit of confidence. When interest rates continually going up, everybody's sort of walking around in this dark cloud, what's coming next? We're waiting for the big storms to hit. And what that does is it just makes people more conservative. So I think with interest rates coming down, it just gives people a little bit more confidence and psyche that when they're borrowing money, when they're going for a loan and they look at the repayment, they're just a little bit more comfortable that they're not going to get themselves into trouble, that, interest rates could move away from them. So I think that's the big part of it. I think a big part of it is the psychic. The interesting thing with interest rates reducing, everybody's circumstances are different. Everybody's incomes, amount of debt, family stretch and everything is different. It doesn't make a massive difference. This actually surprised me. I was running some numbers the other day, and let's say you were a single person earning $100,000 gross a year before the super contribution. A 0.25% reduction to the interest rates would make a difference only of about $10,000 in your borrowing capacity.
Well, you wouldn't get too excited about that necessarily, would you?
No, not really. But I suppose if we've had 0.5 now, so that's $25,000 extra in the borrowing capacity. And if we have 1%, that's over $50,000 on average with the lenders. So some a little bit more, some a little bit less. So it means if people are borrowing right up to their maximum, they can go a little bit further. But again, it's psychic. It might mean most borrowers that we see don't go right up to the maximum. It's what they're comfortable with. So I think that makes the difference.
I guess when I think about what does it mean in terms of actual repayments per year, getting back to your household income, let's say if someone, I don't know, if they borrow 600 odd thousand and buy into something at 750 odd, probably that's where most people are trying to sort of purchase a house at these days.
Yeah, well, let's say for $500,000, for $500,000, for every $500,000 that you borrow over 30 years, so a new loan, the difference in repayments about $80 a month is what you're paying on 0.25. So what's that a year? It's going to make a bit of a difference over 12 months, isn't it? So it's all going to add up. But as interest rates come down,
Yeah, so about $1,000.
yeah. But if we get 1%, that's $320 a month. So that's a big difference. $320 a month if interest rates come off 1%. So that's where it does make a difference. The more income you have, the more difference it makes. So if you're a couple and you're both earning, and let's say you've got a household income of a couple of $100,000, well, then for every 0.25 is about 25,000 extra you can borrow. So if we've had 0.5, that's 50 grand. If we end up with 1%, that's an extra $100,000. So that makes the difference.
Yeah, that adds up.
Yeah, if you're a couple with one, say, working part-time, making, say, only 50 grand a year, it's about the same as the single person. So it doesn't make a big difference, but certainly that extra income can make a difference. The thing that makes the massive difference is income. It's just stunning. If you have one person working and the other person not working, and all of a sudden that person gets a part-time job, say, making $30,000 a year, assuming the expenses don't go up, and of course they would if you had children, because you got daycare and things like that to think about, but that extra $30,000, most of that tax-free, your borrowing capacity goes up hundreds of thousands of dollars. It just makes a big, big difference. And that's, I suppose, why we're seeing most young couples these days both having to work.
Well, I know when we're creating strategic plans for people, I'm always sort of asking and trying to plan out, what are you doing with the family situation, both from a cash flow point of view and borrowing capacity, because you don't want to be, fully to the wall and then have to drop down to one income because you're having a baby, and then you might not be in a position to be able to refinance existing loans if that's the case. But for others that are comfortable within that one income situation, they can then look ahead and say, to add that 30,000 extra salary back in, or 50K, or what, it does make a big difference. And that means we could potentially buy our investment 1 or 3 years earlier, get into the market when there's still good timing ahead. And it certainly then encourages them, hey, I will go back to work a bit earlier because I can see the benefits of that. It's not just about the 30K that they'll make to the household. It's about controlling a larger asset base and potentially making 10% per year over the next 2 years. That's 50K on a 500K property. Well, we're going to probably buy something at more 800K or 700K. So they're going to make 70 to 80K plus their income. So it's about 100K benefit of going back to work when you initially might just be looking at the 30.
Yeah, and that's so true. But I think the other big thing is just that income splitting between two people. So, being able to get one person making 30K, again, not much tax at all is paid on that. Like if the primary income earner wants to get an extra 30 grand in the hand, it's like they're going to have to almost make another $50,000 or $60,000 if they're in a high income tax bracket. So it just makes such a big difference with those tax brackets, trying to maximize those for the family. Even if it means one of the partners drops back to 4 days work and the other one picks up some part-time work to get their income distribution, it's something to consider.
Well, yeah, dad can, and vice versa. Whoever's not spending as much time with the kids can do a bit of a role swap.
Yeah, that's right. Yeah.
Yeah, awesome. So both, it's nice to have both elections behind us now. I've certainly seen a pause in overall activity. Is that what you've seen on the lending and financing side as well? Or
Yeah, I think we have, absolutely. We've definitely seen just that uncertainty in the market, and it always seems to happen with elections. I don't know why, because it doesn't seem to matter who gets in. They're very similar with their policies anyway. There's not much change and life goes on, but it's always the same. Whenever there's an election, people sort of worry a little bit about uncertainty, a bit of that change.
watch the news probably more often than they used to.
And we've had a lot of economic news going on. Of course, the Trump tariffs and all that sort of stuff has just created uncertainty in people's minds. So I think a lot of people are just going, what's going on? We've got elections, we've got, the stuff going on in the US, what's going on? But life just goes on, and people need places to live and people's circumstances change, so they need to sell and life goes on. And, I've been through so many of these different cycles and things. It does go on, but it is interesting how we get a pause. I think a lot of people, now we've got the election out of the way, the fact that the election on both parties had policies that were really there to help people get into housing, it's just going to stimulate the market. And with interest rates looking like they're coming down and coming down further, or having come down and coming down further, my advice to my clients is get in as soon as you can, because I can't see this demand for housing and the upward pressure on prices easing in the foreseeable future. At some stage it has to, but at the moment not. And I think if you wait, as we've seen recently, you are going to be you're going to miss out as prices move away from you. We've been having that conversation with upsizers at the moment because we've seen that bottom of the market come up significantly, and the middle market has moved up as well, but the gap is still attainable for people at the moment. And my fear is that gap will move away from people, that middle market will move away, the bottom won't move quite as much, and that gap expands for clients and they miss their opportunity to get into their dream future home or the area where it's going to be good for kids' schooling or whatever it is. So the conversations we're having with clients at the moment is nobody can predict the future, but check to see what you can do, because if you can do something now, even though the market is tight and it's difficult to buy, it is worth pursuing if you can.
Yeah, that makes sense. I guess for the first home buyers that you work with, there was a whole range of incentives proposed by both parties. At least now we know which ones we're going to get, both from the state and federal. And what does that kind of look like for helping the first home buyer into a house?
Yeah, well, one of the best schemes I think we've had in a long, long time is that first home deposit guarantee scheme. And basically what that is where the federal government steps in and takes on the role of the lender's mortgage insurance company, which, if you don't know, if you're a first home buyer and you haven't got a 20% deposit, you need to pay for lender's mortgage insurance. It's really expensive. Because you're borrowing above 80%, the banks also charge you a higher interest rate. So it's a double whack. You're paying this big fee, which means you need more money to cover those costs, and you're getting charged a higher interest rate. The government coming in and guaranteeing the loan if you have a 5% deposit means you don't pay that fee. And the bank said, well, we've got a government guarantee, so we'll give you the best interest rate as if it was 80%. So you're saving on interest rates, saving on fees. You can borrow more, easier to get into the market with a smaller deposit.
Well, real estate agents love it, and so do sellers too, because if I've got the surety that we're not having to appease a lender's mortgage insurer as well, then it just takes away the uncertainty of the transaction. And I can then, that first home buyer is measuring up a hell of a lot better and on par with an 80% lend borrower.
Exactly right. So I think that has been a really good scheme. And that was brought in by the coalition government when they were in power. Labor continued it, and now going into this latest election, they're extending it. So in Western Australia, we had a property price cap of $600,000, which was great when it first came out. But as you know, the property prices went way above that, and it was now limiting people in Perth to really buying an apartment, and that's not suitable for everybody. That price is going to go up to $850,000, and there was also income band in there that if you earned over $100,000 as a single, you didn't qualify for 125 as a couple. Sorry, it's 125 as a couple, 125 as a single, 150 as a couple. If you were over that, you didn't qualify for it. Apparently, they're getting rid of that income banding altogether, so anybody can apply for that. So I think that will really help. Of course, the danger is what it's going to do is it means there's going to be a lot of first home buyers out there that can potentially borrow up to $850. That's going to push up prices again, isn't it? So, yeah.
And we don't yet know exactly when, but I thought it was early next year that it is coming through, or we're not sure.
No, we're not sure. It's an election promise. I suppose Parliament has to meet, I don't know, and sign off on that at some stage. Hopefully it's soon rather than later, but we haven't got any dates on that. There's also federal government's bringing in their rent to buy, or not rent to buy scheme, but their buyer assistance scheme, where the government owns part of the property, up to 30 or 40% of the property, which means you only need to buy the other percent, 2% deposit. Again, I think in Perth, it's going to be an $850,000 property limit in that. Again, there is a website for it. There's not a lot of details. They're putting that together. There's no commencement date, but all those things are going to roll out and will certainly help the first home buyer, but we're going to see prices jump. So again,
it's like, do you wait for them to come out if you can actually buy? Because there seems to be a bit of a lull, or do you kind of get in now when you're not competing?
Yeah, well, I think if you can buy now, you jump in before those schemes, because I can see what's going to happen, and that is whenever they announce these schemes, as prices tend to rise in response to those schemes. So if you are a person that is in a position to buy, start looking now before those schemes push up the prices further. Obviously, if you can't qualify and you're on the road, this could help you, but get in early is my scheme. But have those discussions now. You still need with that deposit guarantee scheme, save 10%. So you need 5% to cover the deposit and you need 5% to cover the purchase costs. So you need 10%.
Just real quick before we continue on with the episode, are you getting my email updates yet? If you're not, you're missing out on our suburb intelligence reports, which we tailor and prepare for your individual suburbs of interest, showing advanced stats and insights. Must get onto those. And I also send out exclusive invitations to our events, including webinars, sundowners, and workshops. So if you're not getting those, head on over to investorsedge.com.au/join and make sure you're receiving my email updates.
All right. Well, how do you think, I guess, buyers and homeowners in Perth measure up compared to around the other capitals? Because we look at affordability and think people are doing it tough out there, but we're still relatively affordable compared to places like Sydney and Brisbane. I guess that's in our favour a bit when we consider that population migration is still going to be continued at the full rates, because Liberals were going to chop it down and reduce it, but I believe Labor's going to keep it strong. So, migrants will be assessing, where's most affordable in terms of living, where's the job opportunities, where's housing, affordability. How do you sort of see people weighing up their own household affordability, how much to borrow, sort of in reference to that?
Yeah, it's interesting. I've had some conversations with people about this because I can't work out how Sydney can be so how do they afford it in Sydney, right? And because the prices of properties are so much more and have been so much more for a long time, and their income is less than ours. Perth has really strong income, and in part of that is because we've got such a strong economy and we have a lot of people working in the mining industry. That happens to be a really big paying role for most people that are in that industry, and they make sacrifices. A lot of people have to, do the FIFO gig and all that sort of stuff. So that comes at a cost, but there's a lot more money washing around Perth. The state government is a lot more flush with funds. So doing infrastructure projects and stuff like that, there's a lot more going on. So again, more employment opportunities for those sort of jobs as well. And people working on the roads and the rail, and they're working long hours and they're working weekends and they're working nights, but they're also earning really good money. So there is a lot of money in Perth. But talking to my colleagues on the East Coast, in particularly New South Wales, the sense I get that is in New South Wales is just this real belief and sense and importance of property, that you've got to get into property. Doesn't matter if it's a 1-bedroom flat, that property is where it's at, and people will make sacrifices to own that property. Significant sacrifices. So families will do with one car or no car. They will forego holidays. They will get part-time jobs. So they'll run 2 jobs, do one after work for one on the weekend just to get into property. And these are very generalized statements I'm going to be saying here. Everybody's different. Whilst in Western Australia, I think people still really value lifestyle. One of the great attractions of Perth is the lifestyle. It's the climate, it's the beach, it's the weekend, it's holidays, being able to go to Bali or go on a camping trip. A lot of people driving around in very expensive 4 drives and caravan boats and all sorts of these sort of things. We value that. I think we value our lifestyle. So people, often when I'm seeing people and I have a look at them and see what they can borrow, as far as we're talking about these affordability limits at the moment, they're horrified. There's no way they want to borrow that much because they want to still have that lifestyle. So I think there's still a lot of scope in Perth for growth and people to be able to afford property if that's what they choose to do. And the same applies to property investors on the East Coast. There's a lot of people, really aiming to become a property investor. They've researched it. They understand the benefits with the negative gearing and the rental return and all the benefits that come from owning a rental property, and they're prepared to pay that cost to get into it. And I don't know, it seems to be a little bit less on the West Coast. I think it's growing, but I think there's less of that at the moment. So, and as we saw when the eastern states investors swarmed into Perth, I mean, they were like locusts. It was they came across the borders like a locust plague. But yeah, hopefully local people can see some of the benefits from that. And if you get the structure right and you buy the right property, the cost after the rental return and after the tax deductions and all the rest of it, there is a cost, but it's not a huge cost. And for the potential growth in the future, which can be significant, it can be costs that really make life-changing differences to people.
Well, on the backdrop of what you mentioned earlier about knowing that rates have turned the corner and they're not likely to keep going up now, but they're more likely to keep going down, I think people can look ahead with a bit more confidence and before it used to be, well, how are we going to manage if things keep going up? Now people can have a bit more confidence and extend a little bit further on the backdrop that things are going to most likely come down and only become more affordable, with rents still increasing in most areas. And so I think that total cost to hold a property, when we say, say if you're borrowing 600K and it's your savings on a 6% loan or something thereabouts, in a year, if you're getting a 1% reduction, that's 6K. If the property was costing you 22K and now all of a sudden it's costing you 15K, that starts to become a lot more manageable, especially if you've got multiple properties. And then if your rents go up another 20 to $50 a week, the gap bridges. So at $50 a week times 52 weeks, you're at another 2,600. So you're down to, more 10 to 12K to hold a property again. So
yeah, absolutely. And I think that does make a massive difference. And as you know, we've seen really strong rental growth, right? So that gap between what it's costing you to hold and what you're paying out each month is shrinking, and that gap between what you're receiving and what you're paying out is also shrinking. So I think that's something that existing investors should be aware of as well, that this rate reduction is across all their loans, of course, so it makes a big difference. And there's some really good deals at the moment. We're talking, owner-occupied rate now, sort of, if you've got a 20% deposit, is sort of, with good lenders, probably starting from about 5.64, 65, somewhere around there. And investor rate's not that much different after this rate reduction, sort of round about the 5.79, 5.8 with some lenders. So pretty low rate. So, the rate I wouldn't call those sort of rates high. We're sort of probably on long-term average rates at the moment. But what has changed, of course, is that people have a lot bigger loans than what they used to have. So we saw the damage, or not damage, but the pain it was inflicting when interest rates were up 0.5 higher than what they were today. And in the 90s, interest rates went 17%. Now, people's loans were so much smaller back then. So, it had a similar feeling recently to what it had back then. So, if we get some more interest rates reductions, I'd be saying again, interest rates are really quite cheap. I've done a loan this week for somebody and they wanted a fixed rate because it sorted their personal requirements, but we fixed it, I think, at 5.19 for 2 years. So, so there are some pretty good rates around at the moment with a downward outlook. So, yes.
Yeah. Well, I guess a lot of investors and homeowners do have that equity that they can look to make use of now. And when I'm doing appraisals for people, they're actually really surprised at what their property values are up to. So I think it's also a case of being clearer on where your prices are at on your properties, what you can do, what you can afford to do, still planning in having that lifestyle element that we so much want. And if you thought about the home upgrade, as you mentioned, now's a really good time to consider doing it, getting that growth strongest in the middle once you've upgraded. So you get it, you double dip, then you get it in the bottom end, and you get it in the middle. And maybe I don't know if the market will continue to flow through to the top again, because it sort of started at the top here, but the top is still seeming very undervalued to me as well. So
yeah,
time will tell.
Yeah. And I think, just the other thing, which is a thought that I always come back to as far as, the prices that people are paying for properties now and is sustainable, is that replacement cost. So you see what land is billing for and what it's costing developers to get that land on and then to put a house on. Those prices have just gone up so much that it's really expensive. It's really expensive to buy land. It's really expensive to build. And developers that are looking at doing multi-story or stuff like that, the numbers still aren't stacking up for them.
It's very difficult, yeah.
Yeah, so it's hard to see how I don't think prices are going to come back from here in any foreseeable future. I think all the everything I've seen is still predicting future growth. So again, I think, a call for action for people that are thinking, they want to look at options. Should we be upgrading? Should we be doing this? Should we be doing that? I think, even though we've seen massive growth and everything's changed, I think it's still an opportunity at the moment for people to look at their options and see what they can do. And if they can do it, it probably makes sense to pull the trigger and do it sooner rather than later.
So let's say someone does want to get finance ready. They might have been out of the game for a little while. And how do you start getting things together so that you look as good on paper for the banks as possible?
Yeah, so I think, the way the banks look at things, all the lenders are really keen to lend, right? That's their business. They make money when people borrow from them. So they're all really keen, but they are heavily regulated. And there's certain rules in place for lending that all lenders have to sort of comply with. So what basically they want to make sure is, one is that you've got equity or a deposit. So if you're a first home buyer or trying to get into the market for the first time, you need to save. You've got to have those savings. If you've got property already, like you just mentioned, Jared, time to get your properties appraised and see where they are. It might surprise you just how much equity you've got.
Well, happy to do that for anyone as well. Like, I sell properties all over Perth, and each month I'm doing sort of anywhere from 80 to 100 appraisals for people. I do them online because all the data is available. It's very rare that I have to ask for photos or to visit. And if someone ends up going ahead to sale, I obviously always go out and look at suggested improvements and how to present it and go deeper at that point. But yeah, I'm certainly able to give people an appraisal if they want. So just reply to any of emails or get in touch with me and let me know which addresses you want them on. And then you can start to flow that around to your finance broker, such as you.
Yeah, that's great. That's a great service. So that's the first thing. The second thing is you've got to be able to afford the loan. And we've still got that 3% buffer with most lenders. Some lenders 2%, but most 3%. So what they look at is they look at how much do you earn. So income is very important. We've spoken about this before, but look for ways to maximize your income. Ask for that pay rise. Go for that promotion if you can do that. If there's one of you at work and the other one's thinking about getting back into work, if they get back into work, even if it's part-time, makes a massive difference. The other part of that is what else have you got going on in your life? So the bank will look at what you're spending your money on. So they will trawl your bank statements. So if you're spending heaps of money on takeaway food rather than maybe cooking at home, if you are buying coffee every day, maybe rather than bringing a thermos, if you're a smoker and spending $50 a week on legal cigarettes as opposed to going and getting the illegal ones that everybody seems to get, you save. It's a big expense. So your expenses are important. So I suppose just take a check on that. If you're thinking about borrowing in the future, have a look at where you're spending your money and just be responsible with that because the banks will look. The third thing is what other loans have you got and what loans are going to be in place when you borrow money? Any existing loans have to be accounted for. So if you've got a personal loan, you've got an afterpay, you have credit card limit. Even if you never use the credit card or if you pay it off in full every single month and have forever, the limit will be taken into account. So you can look to consolidate those loans. You also want to make sure that your history is really good. So it's really important these days that you pay bills on time, that you pay your credit cards on time, that you don't go over the limit, that you pay them by the due date, because this stuff is starting to be tracked on your credit file. But you can get a copy of your credit file and you can have a look at that and see what your score is and see if there's any issues on there. That all make a difference. So they're really the first things I think to do. The next thing would be to talk to somebody. So talk to a broker about what your borrowing capacity is. So you know what your borrowing capacity is. The brokers will obviously ask you for some data. They need data to be able to have a look at that, but can give you a pretty good indication of what sort of range you can borrow at. And obviously with interest rates, as we've spoken about coming down, that increases. Yeah. So I think they're the first things you should be doing.
Well, that sounds like a really great place to start. And, how easy is this? Like, what's involved? I mean, some people still think about going into their local branch. Are local branches even open these days?
Well, depends who you bank with. Good luck if you're in Bank West. They don't have any branches. Look, I think the last stats I saw is 76% of all loans in Australia are through a broker. And there's a reason for that. The brokers in the marketplace are normally experienced people. They have to be qualified. And every lender is different, right? So it is well worth seeing a broker. There's no charge to see most brokers to have a conversation about what your borrowing capacity is. Income is an interesting thing, right? So we often ask to see your pay slips and understand your income because the banks will assess income differently. Depends on sometimes what occupations you're in. Overtime can be assessed differently by different lenders. If you're casual, the big thing to remember there is most lenders need to be there for at least 6 months because they're trying to average income. So part of your conversation with your broker is if you're thinking about changing your job or going to a different job, have that conversation and we can explain to you what the implications are for that. So, and that's part of the reason you want to get in and see a broker early, just to make sure these things are ticked off, because the last thing we want you to do is be in a job where you're getting regular overtime. You suddenly switch jobs to another job where you're getting regular overtime, but we can't use that overtime because it's a new job and we need to wait 6 months. If you'd known that before you changed job, you might have said, oh, I'll hang on to this job until I buy the property and then switch jobs, So there's just these sort of conversations we can have to make sure you're in a position.
I find as well, when I'm doing strategic plans for people, there's usually a bottleneck for someone, and that can either be their income, which translates through to their borrowing capacity, or it's their available equity or deposit. So it's really nice, and I find it helpful to know what that bottleneck is for someone, because then if it's more income, you go focus on that. If it's you need deposit, then you focus on your savings and revaluing your properties and getting the equity out when you can. And is there any value adds you can do to your properties to speed that up? But where people often go wrong is like they're focusing on the wrong thing. So the client the other day, oh great, like I've increased my income by heaps. Oh, but I've got no more deposit. At least when you increase your income by a lot, you can save more and then speed up that other bottleneck. But it also happens the reverse way. I've got people with massive equity in spades now, but they can't do anything with it because their partner has gone on maternity. They're down to one income, haven't been pushing their overall income situation as strongly. And it's good to you go through different phases and you have your different focuses. That's all part of life. But for them, they've got 500K equity to make use of for those deposits when they can get their borrowing capacity back. And so they know that's what they need to focus on.
Yeah, absolutely. And I think, everybody's circumstances is different. Everybody's journey they're on is different. And the key for all of this is, we need to personalize the advice for the people so they know. And it's complicated. There's lots of different rules and regulations and little things that can trick people up. And that's why you work with people that know this stuff, that do it day in, day out, because we're always, we always joke, we get an application, it looks good, but there's always one thing, there's always something, it's just that can derail it if we don't deal with it or flag it early on and have a solution for people. So I think getting in early to get this stuff checked out before you move is critical. And in this market, as you know, Jared, unless somebody has been pre-approved or had meetings with their broker and been a detailed meeting and go through it all, you wouldn't even accept it. Why would you accept the offer?
So on the weekend, I had a very first home buyer focused property rather, and I had 30 groups through, 10 people wanting to make an offer. When I went deeper, there was like only 3 out of the 10 that had pre-approval or a letter of eligibility or like extreme confidence. And those other 7, this was a much more extreme example, but even if they're willing to pay the most, I'm then really concerned and then weighing up, like, do we take the chance on them or do we just, and this is the decision for the owner, but it's going to come with my recommendation either way. Do we accept look at the 10K less option? They're not throwing the kitchen sink at it, but they're fully dialed in, fully ready, fully pre-approved, they ready, set, go. And that's going to be a much safer bet.
There's so many little things that can just throw out an application that you've got to, the vendor would be silly to take that 10 grand offer with people that are unproven when they've got people that are lined up ready to go, because the delay can cost them a lot of money. So I think getting all your ducks in a row is just so important. And knowing the road ahead as well. So not everybody we see is ready to go. But at least they've got a plan and a map of what they need to do to be able to get to be in a position where they are ready to go. And I think that's just critical. And why should people know that if they're not in the industry? Of course they don't. They specialize in other areas in life. That's for us to be able to put that plan in place for them and then for them to execute it.
Yep. Awesome. Well, that's a good place to finish things on. Thanks for joining us, Nick. And if you've enjoyed listening to this, I'll put Nick's details in the show notes. If you need a good finance broker, he's at Purely Finance, and I trust him and use him with all my personal finance. So feel free to reach out to Nick. And if you've liked and enjoyed this episode, feel free to share it with friends and subscribe on the various channels. And every month we help property investors just like you with creating a strategy, then going through their whole journey from buyer's agency to property management, and then strategically selling when they need to. So get in touch if we can help you with any of those things, and look forward to helping some more listeners this month.
Thanks, Jared. Been fantastic.
Catch you soon. Bye.
Nice to chat. Bye.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.